it's going to be a really bad, kind of like an S&L 1980s type crisis. The market probably drops 20 to 30% from here, because at the end of the day, Maria, we're trading at 19 times earnings, and we have like literally 4 banks that have blown up in the last week. We've got one more on the way, probably today or tomorrow.
And that was the Bear Traps founder, Larry McDonald, speaking to me on this program on Monday following the fallout of Silicon Valley Bank. He is now with me once again. Joining me on the telephone is Larry McDonald. Larry, thanks very much for being here. We so appreciate your time. You've been so spot on. And a week ago, it was March 8th, you said we could see a stock market crash in the next 60 days. It's been selling off ever since you said it. Assess the situation for us, Larry.
So it's a rolling crisis. So the bottom line is when you hike rates that much, nearly 500 basis points in 14 months, there's leverage underneath the system and there's connectivity that none of us can really see. And we see it after the fact, and analysts become aware of it. I mean, the entire street of Wall Street was calling for a soft to no landing 10 days ago. So, your best and brightest at Goldman Sachs didn't see this. And so remind people, no regulator on this planet would have taught this, right? If Goldman Sachs didn't see it, a regulator wouldn't have taught it. Because the tentacles of leverage go into the shadow banking system. They go around the world. They're connected to Europe. And that's what's happening. It's just the tentacles of leverage oozing their way around the planet.
So where does this go now? Credit Suisse right now is at a record low, Larry. We're looking at a real bloodbath for some of these banks again today, in particular the European banks. Credit Suisse is off of the lows, and it's still down 18% right now. UBS, HSBC, Deutsche Bank, all down this morning. How do you see this negative leadership coming from Europe and the European banks now? Is that another leg to drop?
Yes, yeah, exactly. So the street was looking for 50 basis points of rate hikes tomorrow from the ECB in recent days. So the beast in the market is taking central bankers in the United States and Europe and slamming them over the beast's knee, right? So everything the central bankers wanted to do going forward is now highly suspect. Rate hikes are going to turn into rate cuts very shortly. And what's happening in Europe is just a follow-on relationship to the U.S.
Well, this is a good point, and it's one that Tiana just brought up. Tiana, because I know you've got expectations for the Federal Reserve at this point, Larry. Tiana.
So you predicted a couple days ago that by the end of the year, the Fed would cut by 100 basis points. But my question is, we just saw that CPI print come in at 6%. Committee for Responsible Federal Budget saying we're on pace for the year to end at 5% CPI inflation. How does that pair with the fact that you have Jamie Dimon predicting that we're going to have 6% terminal interest rate? What are the conditions in which the Fed decides to cut rates, let alone just hold them rather than raise them?
Yes, that's a great point. And the Fed, we've never had a problem like this. That's one of the reasons why I was calling for a crash, because at the end of the day, the Fed doesn't have the same muscle that they've had in the past. So what happens is when you have this type of deleveraging or a credit crisis, it causes, it's like grease lightning deflation. So whatever we saw in those prints, and you made a great point about CPI, whatever we saw is literally, as Vladimir Lenin almost said, there are weeks where decades happen, and then there are decades where nothing happens, right? So we just had like a week where a decade happened. So the velocity and change of CPI is exploding lower right now. I don't think we go back to 2%, but it still gives the Fed room to cut rates this year.
So, Larry, tell us about that. The Fed is meeting next week. What are you expecting?
Well, the street as of yesterday morning, after the CPI, still was at 25 bips. I don't think they can possibly hike into this. So, like you just noted, they probably won't cut this meeting. But the hike's gone, and they cut, the next, and then they basically use their vocal cords to say, okay, the path's going to be a lot easier, which will help. And then as things get worse and worse, the beast in the market will force the Fed to cut, probably within, I think the first cut would be probably before the 4th of July.
Well, you said the first cut would be when?
Before July, before the cookouts, and the 4th of July.
Uh-huh. Okay. Your thoughts, Adam?
Yeah, interesting. So, hi, Larry. It's Adam. So, are you saying that the Fed is effectively going to do nothing between now and July? They're not going. They're going to stop raising rates, but they're going to wait until July before they cut.
Yeah, I mean, the street's been calling for, like, a week ago, week and a half ago, the street was looking for at least another 75 bips of hike. So if they stop, that is a dramatic, like, change in the path, which is going to help a lot. It's almost like cutting. When you're promising 75 bips and then you pause, it's essentially an ease. Right?
Well, question for you, because Marie and I were debating this. Does the market like that from the Fed? Does the market like a cut from the Fed? Or does the market say, oh, my gosh, then it must be really bad if they're cutting?
Well, this is important. I'm glad you bring this up. So what happens in crisis like Lehman, COVID, especially COVID is a great example. The Fed reacts to the beast in the market first, and they don't do enough, right? And you remember the first 2 or 3 actions that the Fed put forth as COVID was developing in late February, March of 2020. That's where the market was not happy with the Fed, right? And it was the same thing with Lehman. When they came up with the first TARP plan, as Lehman went down, it wasn't approved, it wasn't big enough, and the beast in the market once again forced the policy response out of Washington. So that's exactly what's playing out. Like they pulled out a weapon, right? This FDC backstop for uninsured deposits, and it's just not enough, right? So they need to do more, and the market wants cuts.
Larry, is there anywhere to hide in this market? How do you position yourself with the Dow down 515 right now?
Well, cash is a good spot, but we're going to have a great opportunity to buy here the next 2-3 months because you got to buy into that policy response. But gold miners, value stocks, David Einhorn's crushing it this year. Greenlight Capital crushed it last year. Buffett. So long short value funds are probably the best place to be because they're long value stocks, which are probably the safest part of the market, but they can also short growth. And
okay.
So Berkshire Hathaway doesn't do that. Berkshire just uses cash, but Einhorn and Buffett, I think those are two safest places to be.
All right, Larry, we'll leave it there. Great to have you on, Larry. Thanks very much.